What is going on in the crazy world of commercial real estate lending in, what is this, November 2020? And I wanted to just talk to y'all about what's going on, feet to the street, with some of the deals I'm working on as it relates to lending. Okay, and we all know, or most of us know, in the commercial real estate business, things are different than residential. In the residential single family home world, loans are cranking out. They're giving 2-something% interest. Now they still want you to sign away your wife and kids, if you will, to get that loan. So you got to qualify, jump through the hoops. But the money is flowing, deals are getting done, refis, all of that. In commercial real estate, different set of challenges. Now deals are still happening. It's not a crash. There's not a crash. But there is some challenges in the marketplace. So today's video, we're going to be talking about what in the world is going on in the world of commercial real estate financing. Okay, and I'm just going to be basically talking to you about, what's going on in my world and what I see, talking to different lenders, working on different deals, and maybe what are some solutions. And I think that's the key. What are some solutions to working through difficult situations, working through financing this pandemic in the Bay Area in California, where the rental laws are such that you can't even really evict anybody right now, and people are having legitimate problems paying rent, both as home residents, people in apartment buildings, and both as business residents, people in commercial properties. Because the reality is, this pandemic has affected us all in one way or another. And here in the great state of California, the laws are always pretty stringent. But right now, if you own an apartment building, especially in the Bay Area, and people are not paying you rent, you're going to have a hard time getting them out. And in fact, there is no real horizon on when you might be able to get them out. And when it comes to that time, they're not going to have to pay you all of the back rent. I believe the number is about 25% of the back rent. Don't quote me on that. I'm not a lawyer. But the bottom line is, somebody doesn't want to pay you. They don't have to right now. And navigating through that is very difficult. Now, there's a lot of me to say this. A lot of my clients are saying their tenants are paying and they're working through it. All right. As a result of all of this, though, the lenders taking a step back. They're taking a step back. And you guys know these lenders, we love them, can't live with them, can't live without them, but they don't like risk. They don't like it that much. And so what I'm seeing in a lot of the deals that I'm working on is a reduction in the loan to value. And I have seen this on a deal, an office building deal. We are in escrow. We're supposed to be closing next week. They reduced the loan from 65% LTV to 55% LTV. And the debt coverage ratio, which is 1.2, the debt coverage ratio, the existing rents, which by the way, on this building, the tenants are paying, that was met. But the bank feels as though if some of those tenants stop paying rent, we got problems. So the bank is saying, hey, we're going to be ultra conservative and take that back from 65 to 55% LTV. Now, that's a pretty conservative bank. All right. So the first thing I want to talk to you guys about is not all banks are created equal. The big banks, the Wells, the B of A, the Chase, the U.S. Bank, the Bank of the West, are the most uptight lenders that there is. These people are uptight. They're, anything that smells like risk, they're going to discount the loan amount. They're going to just discount your income. They're just going to discount you. Okay. Not all lenders are like that. So I just wanted to say, as you're working a deal, you may want to have a couple of lenders that you're talking about. Now, lenders hate when you shop them, when you are talking to other lenders and so forth. But you know what? This is coronavirus time, man. We need to get deals done. So I need a plan and I need a backup plan, and luckily on this deal I'm working with a very, very sharp agent. I'm the listing agent, buyer's agent, very sharp. He had a backup plan. He switched to the backup plan. The backup plan says, hey, look, as long as everything checks out, as you guys said, we can get this thing done at 65% LTV, and we can get it done before the end of the year. So the solution to that debacle, and I'm gonna call it debacle because the numbers work out, the appraisal works out. You say you can do 65, And then you say at the end, come to close, we can't do 65. We want to be at 55. 55. That's a debacle. However, solution is you got a couple options in your back pocket. And the options you might want to look for are community banks, credit unions, or, just banks that are bigger in lending than they are in banking, if you will. Okay, so maybe they're a little bit more, risk, that they have a higher risk tolerance, and then maybe they're able to do something a little bit more flexibly than the Wells Fargo, B of A's, and Chases of the world. So maybe going into your deal, and I'm saying this to myself, next deal, we want to make sure that we got lenders who are not as uptight as the big banks. And I'm not slamming them, but just look, at the end of the day, they uptight with it. It's hard to get deals done with these guys when they're scaling back LTVs. So what I also see, though, is that the debt coverage ratios have gone up a little bit. All right. I know a lot of lenders were doing 117. Okay. And if you don't know what the debt coverage ratio, just, what that is the net operating income divided by the annual debt service, the annual mortgage payments. Not the taxes and insurance, just the principal and interest, the annual mortgage service, the annual debt service, excuse me. So you take the annual net operating income divided by the annual debt service, that's going to give you a ratio. That ratio needs to be positive, obviously, but in times in the last couple of years, a lot of lenders were able to do 117, even 115. Now everybody's telling me I need 1.2. I need 1.2 at least. And I've even seen, we need 1.25. So they're tightening up, the money's still out there. Interest rates are great, by the way. So let me just say that. I always like to keep it positive. The interest rates are outstanding. To get to that interest rate, though, you got to jump through some hoops. All right. So debt coverage ratios are tightening up. All right. And at the same time, what I'm seeing and experiencing is they're saying, hey, here's your NOI. We might want to discount that a little bit, to be conservative. So the way they're discounting it is adding additional reserves into your operating expenses. I've seen that on 2 deals I'm working on. Okay. What that means is, as we as brokers, agents, investors out there, we got to be a little bit more conservative in our underwriting of deals. Okay. When we're listing properties, when we're representing buyers, or if we're buying properties ourselves, we got to bust those numbers down. There's a time to be optimistic. There's a time to be, we can make this happen. We, as entrepreneurs, we kind of think like that, intuitively. But it's a time to put our investor critical hat on. And even if you're just brokering the deal, you kind of got to do it, because when you get to the lending table, they're definitely going to do it. So another word to the wise is, let's start being a little bit more conservative with the way we run our numbers. I kind of cut my teeth in the CCIM organization, got my designation, been a part of the organization for quite some time. When I was taught how to run numbers, we was taught how to run numbers in a conservative fashion. I mean, based on reality, based on the actual profit and loss statements, and, figuring out real numbers. So I think that is what we need to really get back to. The last 3 years, it got a little optimistic because the rents were just outrageous. The economy was outstanding. I won't say it got loose, because still, to get a loan, you had to really qualify for it. But it just, prices were outrageous, rents were outrageous, lending was just, plentiful. We got to scale back a little bit, and just we got to be diligent about the numbers that we are, either as listing agents, buyers, brokers, professionals, that we're dealing with, and I think that's the key. I don't see is what I saw in 2008 and 2009, where lenders are saying, we don't want to look at your deal, we don't want to talk to you, we're just trying to figure out if we're going to be in business tomorrow. We don't see that. And I think a lot of lenders have, their capital positions are good. What they're saying, though, is there's trouble in the horizon, so we want to make sure that if we're putting out loans, these are going to be good loans. I can't necessarily blame them for that. What I can say is, let's just find the guys that are going to work with us a little bit better. I don't think people should just be discounting NOIs off of where they are mid-deal. My thoughts. I'm just the broker. What do I know? right? So the another deal I'm working on, apartment building deal, Central Valley, and a similar thing as we're beginning the underwriting process. The loan amount changed, okay, and that one now that's kind of a guaranteed stream of income on that property, but in that one, the numbers were tight to begin with. We're exchanging buyers buying a property out of a 1031. The numbers tight, 5 cap rate range. So what we're doing on that deal now, this is I think a way to get some deals done. If your LTVs get dropped on you mid deal, which it's happened to me 3 times in the last 2 months. I think it's going to happen to a lot of us that we're mid deal. Now, before the deal, you kind of get your ducks in a row. But I'm talking about mid deal, and I want to be a solutions oriented person. So if you're mid deal and they drop your LTV, traditionally what we'll do is, if you're representing the buyer, you ask the seller to drop the price. Of course, sellers don't want to drop their price, but if they drop their price, that's an easy solution, right? Say they say, well, we're not dropping the price. It's just we're not doing that. We want to stick to our guns, which is what a lot of sellers are actually saying right now. And if they don't have to sell, that's probably what they're going to say. So a traditional way to close that gap is say, well, Mr. and Mrs. Seller, can you carry the difference? They drop my loan amount from, let's just say, like my example, 65% to 55% LTV. Mr. and Mrs. Seller, can you carry that difference? And traditionally, some lenders, some lenders will allow the seller to carry a second mortgage to get the deal done. The challenge with the second mortgage idea in today's marketplace is, again, the debt coverage ratio. Because then if they do, a lot of banks, lenders, they do not allow second mortgages, a lot of them. Some of them do. If they do, though, what they will require is, hey, we need to know what the debt service is on that second, include that with the first, and it still needs to meet our ratio requirements, 1.2, 1.25, whatever it may be. And 9 times out of 10, it's not going to qualify because that's why they dropped the loan amount in the first place, possibly. So that is the challenge. What we're doing on the deal is very creative, but it's been done before. We're saying to the sellers, hey, lender will not allow a second behind their loan. What they will allow you to do is take your carried interest, the difference between what the loan amount that they dropped is, and they will allow that to be what's called preferred equity. So in other words, they're going to carry that back in a percentage of the LLC that purchased the property. So they're going to have still a percentage of ownership in the property. And we're structuring that ownership similar to where, they're not going to get a flat return. It's going to be pro rata. It's going to be real ownership. But they're not going to have the controls that the new buyer will have. There'll be a limited, member, if you will. But that's a way. It's just a way. It may not work on every deal, but it's a way that we're using some creativity to get a deal done when things change mid-escrow. And what we're saying is, okay, and because the lender will not allow you to carry a second, we're asking you to carry your equity in the form of preferred equity on the new LLC coming in. There's some complexities with that. There's some legal documents that need to get drawn with that. It's a solution. And I think that as we go through this, I don't know what you call a pandemic. It's certainly not a crash. I don't even think downturn is the right word. It's just this weird period of time. We need to remain creative. And when the lenders are saying, because prices have shot up and they are where they are, the debt coverage ratios are tight and they have tightened them up. Seller financing is a great way or option to get deals done. And what I want to say to you is sellers can carry preferred equity interest, and that is a method of seller financing that can potentially be kosher and okay with the lender who's doing the deal and get a deal done. Are some lenders going to have a problem with that? Yes, probably. Are all lenders going to have a problem with that? No, I'm working on that situation right now on the deal. So what I want to try to do is provide you guys quality content that can help you to navigate through these waters. I always like to keep a positive outlook on this. I started my company in November 2009. I cut my teeth in the Great Recession. I've dealt with a lot of difficult situations. And so the key, I think, is just to stop from the sky is falling mentality, take a deep breath, focus in and say, what can we do to get this deal done? Is closing this deal possible? What are some of the possibilities? And work with the buyers and sellers. Some deals not gonna close, man. It just is what it is. But if we can take these positive problem-solving solutions to the marketplace, particularly with dealing with lending challenges, which you're going to say, we're dealing with this as a marketplace. It ain't just me. We're dealing with this as a marketplace. This is a way for us still to get deals done. I closed deals in 2008. I closed deals in 2009, 2010. We really got rolling in 2011. And that is not what's going on. At those periods of time, lenders was like, nah, we're just not making loans. So to get a loan from a lender in 2009, which I did on deals, requires creative problem solving. Let's take that into this marketplace now. Let's get deals done for our clients as investors, and for buyers, for sellers. Let's just get deals done. Let's figure out how to make it happen. We can do it. Let's go on and get that work. If this is valuable, throw me a like. If it's not, throw me a dislike, give me a comment, give me some feedback, and subscribe to the station. We're always coming out with valuable content, and we're going to keep that going. I hope this helps, and best of success to your investing career. Peace out.